The broadcast is now starting. All attendees are in listen-only mode.
Okay, welcome everyone to our latest webinar in this TaxLink webinar series. Today we're looking more specifically at U.S. expatriation or renouncing your U.S. citizenship and all of the tax implications behind this decision. Just to get some admin issues out of the way before we get started, Virginia Latorre Jecker is with us. You cannot see her because we had some tech issues, but she is online and you'll be able to hear her. Also, we are recording this I guess webinar, and we will have a audio recording and a transcript available to all listeners and everyone else in the taxing community within a few weeks. Also, keep in mind that if you're listening and you have any questions, make sure to use the GoToWebinar control panel to submit your questions. I will then actually try to work them into the discussion as we go along. So with that said, I will be moderating. I am TaxLinked's content manager. So without further ado, I'd like to ask each one of the panelists to introduce themselves. Jimmy, how about you go first?
Yeah, my name is Jimmy Sexton. I'm the president of Esquire Group. We're a boutique international tax firm that helps mainly U.S. citizens and businesses doing business or abroad or living abroad, and we also work a lot with people who have expatriated or in planning their expatriation.
Excellent, thank you, Jimmy. Leonard, how about you?
Yes, my name is Leonard Tuber, and I am the CFO of Leonard Tuber USA Income Tax Services in Jerusalem, Israel. I am an accountant, and my practice is primarily in U.S. tax compliance, preparing U.S. tax returns and representation before the IRS. And of course, we've done quite a number of expatriations over the last couple of years.
Excellent, thank you, Leonard. And Virginia?
Right, sorry you can't see me today. I'm Virginia Latorre Yeaker, and I'm a specialist in United States taxation, mostly as it relates to international issues for both U.S. and non-U.S. individuals. And I've been practicing since 1983, and I've been living abroad since 1986, first based in Hong Kong and now Dubai for the past 16 years. And I've been working in international tax planning with many law firms and accounting firms, major banks, and so forth. And specifically recently, I've been working a lot on pre-immigration tax planning and expatriations, as well as tax planning for Americans living and working overseas. So that's the situation for me. Happy to help anyone that needs further guidance.
Excellent. Thank you very much, Virginia. So let's get started with the Q&A session. I have 10 questions here. Most of them were submitted by Virginia and by Jimmy. I think there are some hypothetical situations. There's some questions on many diverse issues related to expatriation. So I'll take them by order. We'll go 1 through 10 and try to cover as many as we can. So the first question we have here is, what is a covered expatriate, and what does it mean if an individual is classified as one? Virginia, how about, since this is one of your questions, how about you get us started with that one?
Sure. I would like to first say that because we're all tax professionals here at the webinar, none of us individually knows everything. So I think it would be great if the other participants would, be feeling free to join in and maybe clarify or add extra information that they may have based on their particular practice. So let's look at your question here. What is a covered expatriate, and what does it mean if an individual is classified as one? First, I think we all have to make sure we understand an expatriate is someone who's treated under the U.S. tax rules as having given up his or her status, either of U.S. citizenship or long-term permanent residence. And we'll discuss more of that later. But under the U.S. tax expatriation rules, an individual is treated as a covered expatriate if any of these tests apply. So if you meet one out of the 3 tests, you are a covered expatriate. And as you'll see, it's not a good thing to be a covered expatriate. So the first test is if the individual's average annual net income tax for the 5-year period ending before he expatriated or terminated residency is $162,000 for 2017, and that number goes up to $165,000 for 2018. And it's important to remember this is looking at what the average tax paid was over the 5-year period. It's not how much income the person earned, it's how much tax he has paid. The other test is if the individual has a net worth of $2 million or more on the date of expatriation.
Hey, Virginia, I just want to jump in there really quick, just on the way, because the annual average U.S. income tax can be a little bit confusing. So it's the average income tax liability for the 5 years prior to expatriation. So basically, what you do is for the 5 years prior to expatriation, you add up all the income taxes paid for those 5 years. You divide it by 5, and then that'll give you the average. So if it was, 2017, if that number is more than 162,000, then you would be a covered expatriate. So anyway, I just wanted to add how you come up with that average amount, because that confuses some people.
Thank you, Jimmy. It does. It confuses a lot of people. Okay, so that's the second test again was if the individual has a net worth of $2 million or more. And when you're looking at net worth, people tend to forget what that means. Net worth means your worldwide assets, the fair market value of your worldwide assets on the day before you expatriate, minus whatever liabilities you have worldwide. And that number, if it comes out to $2 million or more, you are a covered expatriate. The $2 million amount is not indexed for inflation the way the annual net income tax average number is indexed. So it's $2 million. It's been $2 million since I can remember. So that's been a long time. The third way you can become a covered expatriate is if you fail to certify on a special form that you have complied with all of your U.S. federal tax obligations for the 5 years preceding the date you expatriated. So you have to basically swear under penalties of perjury that you have met all of your tax obligations for the 5 years prior to the time you gave up your U.S. status. And that means that you've been tax compliant. You filed every form you needed to file. You've paid all your taxes due. And not just your income taxes. They're looking at everything. They're looking at estate taxes, gift taxes, payroll taxes. So this is when people are planning on giving up U.S. status, they should really be very diligent and go for professional assistance to make sure that they are clean and have done everything for that 5-year period prior to giving up the status.
Absolutely. I was just going to add one last thing, Virginia, with regards to the net worth test and the average U.S. income tax liability test. Is one of the things that's a little bit strange is that the net worth test, for example, it's $2 million per person, right? So if you had a husband and wife and all the assets were community property, you'd basically split them down the middle and say 50% belong to the husband and 50% belong to the wife. So, essentially, if you had, a couple that was going to expatriate and their average income tax, their net worth was, let's say, 3.9 million. You divide that by 2, they're both under 2 million. They wouldn't meet the net worth test. But if they file a joint income tax return, they have to include the entire portion of the average income tax liability. So let's say their average income tax was the 162,000, or let's say 163,000, which would make them a covered expatriate. They don't get to split that 163,000 in 2. They both have to count the entire 163,000, which would make them both covered expatriates. So that's I think that's an important thing to remember.
Very important.
Leonard, do you have
just one?
Do I have anything important to add? No, I think Virginia's doing a very good job of explaining what a covered expatriate is. Certainly, the certification test, the filing of Form 8854, is very important. It's very important that people go back over the past 5 years prior to the year of renunciation and really make sure that their returns were prepared correctly, because that is something that potentially could make someone fail that certification test, and then they would be a covered expatriate with all the attending consequences.
I would add here
Yeah, I
that
mean,
right
that's
now,
that's something we've seen a lot, where people go to, I don't know, some low-cost tax prep place, or Joe's tax shop in Kansas, and get their returns done, and they think that they're compliant, and then you look at the returns when they're getting ready to expatriate, and they're a disaster, and
Yep.
hopefully you're able to catch it before they expatriate, and you can get it fixed.
Yes, I would add here that right now, and you guys can give us your experience as well. Jimmy, I know, having worked with you on many cases, that your experience is similar to mine. We've not really seen the IRS auditing people who've expatriated at the moment, but I think this area is going to explode because the number of expatriations has increased so dramatically. And
Yeah.
I think that people have been maybe a little bit too complacent, and they're thinking, oh, well, they're never going to look at me. But I've been seeing, just for example, the IRS has these new compliance initiatives where they're saying, we are going to focus on specific areas where we think there's a lot of tax dollars and a lot of penalties that we can get. And one of the areas is dealing with, as I recall, filings for like foreign entities, offshore assets. And what I've seen with regard to Form 5471, which is a very complicated form and needs to be filed when there's ownership in a non-U.S. corporation in many cases, that the IRS has set a very high bar for what they consider to be a properly completed Form 5471. And I think this is an area where people are going to get caught who are expatriating and have not properly been filing a 5471. Because as you guys probably know, this is one of the most complicated forms that exists in our tax world. And it is often implicated when people are living and working overseas.
If I can jump in here, I agree with. I'm sorry, Jimmy.
Go ahead. Go ahead then.
No, when it comes to revenue recognition for foreign corporations, there can be some very complex rules, such as Subpart F income, and possibly a foreign corporation can be also what's called a PFIC. That would mean that upon examination of the 5471, although someone did file the form, there may very well be untaxed income attributable to the operations of that company, regardless of to whether the U.S. shareholder has taken a distribution or not. And I wonder, and again, I don't have any experience with it, but I wonder how a tax delinquency would play into the certification test if those prior year returns within the 5 years prior to the year of renunciation were ever actually audited and there was a tax deficiency as a result of some of those issues.
I don't know,
Well,
Leonard. I think we may be addressing these issues in due time.
Well, that's what I was just going to say. This is something that Virginia and I have talked about at length and read a couple articles on and stuff like that. Is at this point nobody really knows, what would jeopardize that certification, right? Because what if it was, something small like an honest mistake? They used the wrong exchange rate or something, like you all of a sudden going to say that they're a covered expatriate? Or where is the bar to where you would jeopardize that certification? Is it any infraction, or does it have to be something intentional? Or
I would think there would have to be a very high bar that the certification is always to the best of one's knowledge. if someone does go to a tax professional, someone who is licensed and accredited, to the best of their knowledge, they've met all of their filing and requirement to pay tax due. So I would think that there would be a very high bar in terms of invalidating a certification. But these are one of the areas that are still unknown. So it's very important, as you said, Jimmy, before, to go to someone who really is experienced in offshore, in the complex areas of the technical taxation of foreign entities.
Okay. I just
Yeah,
want to
absolutely.
finish up this question with what happens if you are a covered expatriate. Well, now we know how you can become one, but what's the consequences if you are a covered expatriate? There are a lot of tax consequences, and none of them are good. I'll just touch on some of them briefly. A covered expatriate who is treated as if he has a tax avoidance motive, whether or not he likes it. And what happens to him is that he's treated as if he has sold all of his assets in the entire world. It's a pretend sale of everything, and he has to pay what's called an exit tax on the gain. And we'll talk more about that, but this is like a pretend gain that's taken into account. There is a certain exemption amount for a certain portion of it, but he has to pay tax on that. The other thing that can happen to him or her is that any U.S. person to whom they covered expatriate gives a gift later on or leaves an inheritance or a bequest, that U.S. recipient of the gift or the bequest is going to suffer certain tax consequences because he got the gift or the inheritance from a so-called covered expatriate. And we'll deal with more of that later. I think Jimmy's going to cover that. Am I right, Jimmy?
Yeah, I'll
Gift
cover
and
that.
estate. Okay, so I don't want to go into detail.
But one other thing I would just add really quick to that answer is, in addition to the tax on the unrealized gains and the gift and estate tax implications, there's also if you have a lot of tax deferred accounts, so like an IRA, for example, be treated as distributed on the day before expatriation. You'd have to include that in your income. Life insurance with a cash value, annuities, things of that nature, are usually treated as cashed in.
And
so that there's
even
exemption
harsher ones for foreign pension plans. Those foreign pension plans are treated horribly. I don't know if one of you want to mention what happens to them with a foreign pension plan.
If you're a covered expatriate. Pension plan, it's treated like, it's called an ineligible deferred asset. Basically, it's as if you got a distribution of a lump sum. And there are many problems because now someone has a tax liability that how are they going to pay for, because they haven't received any distributions, they haven't had any cash. Another problem is that of double taxation. Someone who is treated as having liquidated their entire foreign pension overseas, and they're paying tax to the United States. Let's say they're in their 20s or 30 or whatever, and then all of a sudden when they're in their mid-60s, they're going to start taking withdrawals in their country of residency. And in their country of residency, these withdrawals from the pension plans are fully taxable. Is Israel or any other country going to give a foreign tax credit for a make-believe sale that happened, 30 years before? Unlikely.
I doubt it.
There are some real issues of double taxation when it comes to these ineligible deferred compensation plans, which are basically all foreign pensions.
All foreign pensions. So if any of you have foreign pensions and you're thinking of expatriating, you really need tax advice. But I think what we've gotten from all of this discussion is that you really do not want to be a covered expatriate. And there are ways, there are planning techniques that are available. You can, speak to us about these at another time, but there are ways you can avoid in most cases, you can avoid and plan for your life so that you won't be a covered expatriate.
I guess this is a good segue into question 3, which is listed on the sheet on our list of questions. This was also submitted by Virginia. For expatriation purposes, there's a dual national exception contained in the U.S. tax law, meaning the exception permits the expatriate individual to escape treatment as a so-called covered expatriate. How does this exception work? You want to start us off with that, Jimmy?
Sure. And I'm just going to, in segueing into this question, I will add one more thing to the covered expatriate thing, which is a non-tax thing. But there is actually a provision also in the immigration laws that says if you expatriated for tax reasons, which you're presumed to have done as a covered expatriate, that they can exclude you from entering the United States. And I've actually in the last couple of years had that happen to a couple. So the IRS is getting
Jimmy, I'm
wondering,
wondering,
a little bit more aggressive
you've had it, yeah, you've had it happen to some of your clients. Did they clearly say, for those of you who want to Google, this is known as the Reed Amendment, R-E-E-D, Reed Amendment. It came in the mid-90s. In the early times, it was not enforced because there were issues with whether this was constitutional or not. And I have heard just through the grapevine that they are being more aggressive in enforcing it, but then they're not really saying that it's because of the tax avoidance motive. In other words, if you apply for a visa to enter the U.S., the immigration officer has complete discretion to grant it or not. I don't believe they have to give you reasons for not granting it. So you may never know why you were denied entry. And I'm wondering, Jimmy, if in the cases you mentioned,
in the cases of my clients, they were told.
Really?
And yeah, I mean, they eventually, all of them eventually got their visas, but it was a nightmare.
Okay.
But
so we see more aggression in this area. Important to know.
For sure. But going back into question 3, the dual national exception. So basically, there's an exception that says that if you're born a dual national, so a citizen of 2 countries, and at the time you expatriate, you're still a citizen of that other country and a resident, and taxed as a resident of that foreign country, then you can avoid the net worth and the average income tax liability tests to becoming a covered expatriate. So, for example, if you were born a dual national with the United States and Germany, and at the time you expatriate, you're still a German citizen and you're a resident of Germany and paying taxes there, then you can avoid the net worth and the average income tax liability test. So meaning, you can have a net worth of over $2 million and still not be a covered expatriate. You can have an average income tax liability over $162,000 and not be a covered expatriate. It does not, however, exempt you from the tax compliance test, which is that 3rd test. So you still have to certify that you've been tax compliant for the 5 years prior to expatriation in order to qualify for that dual national exception. But as long as you've been tax compliant for the 5 years prior and you meet the other requirements of the dual national exception, then you can have a net worth of over $2 million and an income tax liability of over the $162,000. So that's something that's been very useful to people.
Yeah, but I want to add one thing, Jim. In your enthusiasm, you forgot one little bit of the test. In addition to being a dual national at birth and remaining a citizen of and taxed as a resident of the other country, you can't have been resident in the U.S. for a certain time period. So you have to say, I was not resident there for more than 10 years during the 15-year period before expatriation. And that's a matter of counting days of physical presence in the States. Most people that we have dealt with who are expatriating, who come in under this dual national exception, would not have an issue with that last part of the test. But I have had some clients that were educated in the States, for example, and they did spend substantial time there in school and so forth. So for them, we were, you know, very concerned about were they going to meet this little prong of the test. But it all ended up working out. But you have to just remember, if you've spent significant time in the States, even though you might otherwise meet the dual national exception, you have to be very careful on this last portion about residency in the U.S. in that 10-year period.
Yep, very, very good point.
Anything to
But
add,
I
Leonard?
want to.
When looking at the
I wanna-
substantial presence test, especially when it comes to foreign students that are going to the United States, one would have to take into account perhaps other rules such as a closer connection to a foreign country. Even though someone may actually fail the substantial presence test based on the numbers, there may be ways to get them out of that as well. And that's something that a tax professional really has to look at, and it's a facts and circumstances determination.
I want to just raise a point about this dual national exception, because there was an article written by a gentleman who was obviously very affected by this dual national exception. And he gave numerous examples of how, I hate to use the word unfair, but for want of a better word, how unfair it can be. So, for example, he gave several, but the one I liked the most was to illustrate about the unfairness concept is you have two U.S. couples, one is white and one is black. Both of them emigrate to South Africa in the 1970s, and they start families. So these babies that they have are U.S. citizens at birth because of their parents. But under South African apartheid, blacks were denied citizenship of South Africa. So under that circumstance, even though the couples had their children in South Africa and any other kid would be born a South African, the black citizen is denied South African citizenship. So if the white kid and the black kid both expatriated, one of them would meet the dual national exception, the white one, but the black one would not because of apartheid. And there's other examples where you just see, you know, what if the guy's a dual national at birth under Germany, but he works in Switzerland and he's not being taxed as a resident of Germany, but he's being taxed as a resident of Switzerland? Does he have to leave his job in Switzerland and move back to Germany to meet this test? I mean, there's just a lot of glitches that don't work nicely and just don't work in the way I think this exception was really intended. But that's just my 2 cents on that.
Okay. Thank you, Virginia, for that. And let's move on to the next question. Let's look at question 2. We'll jump back to question 2 since we've covered expatriates. I know we can talk about some of these issues for hours, so we'll try to kind of summarize everything as best as we can. So question number 2, can the expatriation rules apply to a green card holder who gives up a green card, or are these rules only applied to U.S. citizens who give up their citizenship? Leonard, how about getting us started with that one?
Sure, yes. The expatriation rules can apply to a green card holder if the green card holder is considered what is a long-term resident. A long-term resident is defined under Section 877E2 of the Internal Revenue Code, and I'll just take a minute to read part of it for you. Any individual other than a citizen of the United States who is a lawful permanent resident of the United States. Lawful permanent resident simply means, in this case, someone who is a green card holder, in at least 8 taxable years during the period of 15 taxable years, ending within the taxable year which the event described in subparagraph A or B. Basically, that means that if at the date of your expatriation, the date of your renunciation of U.S. citizenship, if you look back the past 15 tax years, and in any 8 of those 15 years, and the word "in" is a very important word, okay? If in any 8 of those 15 years you were then you would be considered a long-term resident a long-term resident, not just the permanent resident, but if you have a green card for 8 of the last 15 years, then you are what is considered a long-term resident, and the covered expatriate rules would apply. And if you meet the tax liability test and the net worth test that Virginia talked about, you would be considered a covered expatriate. Now, what's interesting here is the word in. Let's say that someone received their green card on December 29th of one year. Okay? There are only 2 days left. That year, they would still be considered a permanent resident of the United States for this counting to take place. So yeah, a green card holder can be considered a covered expatriate if they meet that time test of being a green card holder for 8 of the last 15 years, and if they meet the tax liability and net worth tests. Now, there are certain planning opportunities that can be done to try to trump this test in the year that, right in, let's say, year 7, before someone meets the 8 years. Some of that perhaps could be filing a tax return as a non-resident alien. But it's very important that people who are considering, because unless you hold it for 8 years, okay, you can have net worth of over $2 million and you can fail the tax liability test. That's fine. But once you hit that magic number 8, and why they picked that, I have no idea, you're already in the world of becoming a covered expatriate.
Jimmy, Virginia, anything to add to what Leonard has shared with us?
No, I think he's done a fantastic job.
Yeah, I think he's covered that pretty well.
Excellent. Okay, so now we have 4, I guess, hypothetical situations that that Virginia has, I guess, drafted for us. We're going to point number 4 in our list, and here it goes. I heard that if I give up my U.S. citizenship, I have to file U.S. tax returns and pay tax for a 10-year period after expatriation. Is this true? Virginia, how about getting us started with that one?
Okay. There's so many myths that are abounding about expatriation. This is one of them. A lot of the confusion arises because the expatriation rules were completely revamped in 2008. The last revamping was done in 2008 with something called the abbreviated, it's called the HART Act, H-E-A-R-T. Under the HART Act, the so-called exit tax contained in the new code section 877A replaced what was known as the alternative tax regime. And this was a punitive regime imposed on people who were considered to have that tax avoidance purpose for expatriating. And under that old regime, for a 10-year period, certain items of income were recharacterized and treated as having a U.S. source for the 10 years after expatriation. So because they were recharacterized to have a U.S. source, they're treated as U.S. source income, and therefore they are treated as taxable to the non-resident alien who has become a non-resident alien because he's expatriated. So this 10-year rule was under the old law, and if you've expatriated under the old rules, then that rule will apply to you. But if you expatriated on or after June 17, 2008, you're subject to the new rules, and the new rules involve the exit tax that we've been talking about and another tax Jimmy's going to talk about, but there is no following you and shadowing you for this 10-year period. That's gone. So you just have to look at your expatriation date to determine which set of rules will apply to you. And as the tax professionals know, the rules have changed so many times under expatriation, and they've always gotten harder and harder and more onerous to live with. So that's one of the myths. And you're going to mention another myth, Matteo, that if someone heard, if I give up my citizenship, I heard I can't be in the U.S. for over 30 days in any year. And if I am there for over 30 days, then I'm subject to tax on my worldwide income again. Is this true? Again, that was part of the old law, and if you expatriated on or after June 17, 2008, that rule will not apply to you.
And I just think that it's so, I find it so interesting that these rules are changed, basically a decade ago. I mean, the people that the last of the people that expatriated under the old regimes are going to be filing their last 8854s at this point, and abiding by those old rules.
10-year rule.
Yeah, that these myths still exist and that people still believe this. I mean, I bet you 90% of the Americans abroad that I run into, and if you get on the topic of expatriation, that they say, oh yeah, I would do it. I thought about it, but I don't want to have to pay tax for 10 years after I leave.
I know.
Not be able to go to the U.S. I just find it remarkable.
But there's one other myth that I think we can add in here. It's on the list, Matteo, so saving you some moderation.
That's
the
all
myth
right.
is, I heard that if I don't file Form 8854 in the year after I've expatriated, which is when you're required to file it, that I'm still treated as a U.S. person subject to income tax on my worldwide income. Is this true? This myth is believed by not only people who are thinking of expatriating, but a lot of tax professionals get this one wrong. And I myself have gone back to the law and say, oh, am I definitely correct on this? Because it's a scary thought that if someone doesn't file their Form 8854, which is the form saying, in part, I certify under penalties of perjury I've been tax compliant for the 5-year period prior to expatriation. That's where you do your tax certification. That they'll still be treated as a U.S. person. Again, these rules were part of the prior law and they were done away with, but you have to be very, very careful with this one because the transition dates get very confusing. But if you are expatriating anytime on or after June 17, 2008, you definitely don't need to worry about if you fail to file your 8854 as being treated as still a U.S. person subject to tax on your worldwide income. You have other worries, like you're going to be a covered expatriate, but you don't have the worry of being still treated as a U.S. tax subject for on your worldwide income. So, but this is one you've really got to look at the transition dates.
Leonard, anything to add on? Sorry.
No,
Leonard, anything to add on these three myths?
A lot of that confusion has to do with the instructions to Form 8854. Even today, you can see cautions on the instruction form that say, remember, even though if you emigrated for U.S. Immigration purposes until you file Form 8854, you are still considered a U.S. person for tax purposes. So many practitioners out there, especially tax return preparers, we go to the guidance given us by the IRS and the form instructions. And unless you're a tax attorney and you really do know how to go in there and research the law yourself, we generally take for granted that the IRS knows what they're talking about and they're going to give us the proper guidance. So a lot of that confusion, quite frankly, does come from the instructions to the forms.
Yes, I'll agree. But the instructions,
well, and
Leonard,
the other
really
thing
look
I
at
think
them,
it's important to.
they're divided up by dates. Like they'll tell you, if you expatriated on or before this date, this applies. It's so cumbersome, those instructions. You've got to be.
They're very hard. They're very hard to read, especially the instruction to the 8854. And people who have little experience, everyone starts from case number 1, and they go to the instructions and they figure out what they're supposed to do, and things are not always clear. So that's where a lot of confusion has taken place. And that's why I think it's very important, and this is, I think, relates to something that Jimmy said earlier. It is very important when you're talking about coming into compliance for the first time. If you're talking about expatriation, it is very important to talk to a tax attorney. Tax preparers, CPAs, EAs have their role in this profession, as well as tax attorneys, and they're meant to complement one another. So if there's anyone who's out there listening and thinking about going to expatriate, you really do have to not only go to an accountant to figure out how to file what you need to file and how to fill out the forms, but take the time to speak to a tax attorney as well. It's very important.
Well, the other thing that I wanted to add is, in addition to the confusing in instructions, and I mean not just confusing, but they're just very limited. The IRS has really done a poor job at giving any guidance on the expatriation rules. I mean, we're still working.
And maybe that's on purpose.
Yeah, but I mean, I think we're still. We're still working off a guidance that was released in 2009, and it's it's just guidance.
I know.
It's not even.
I know.
And that's really the best we have. I mean, the tax professional community has really had to kind of figure it out as we've gone along.
Mm-hmm.
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 Okay, great on those three myths, I guess, and discussing them. Let's look at the fourth myth that Virginia posted for us, and this one goes back to the exit tax, which I know has been mentioned a few times by Jimmy, so we'll get started. Jimmy can take a crack at this one. I have heard about the so-called exit tax, but I don't know much detail. What does it entail? What if I don't have the money to pay the IRS the exit tax? Jimmy?
So there's a few different parts to the exit tax. The major part of it is a mark-to-market tax on all of your assets. So it's basically a tax on the unrealized gains. I guess the simplest way to explain it is you figure out all the assets that you have in the whole world. You figure out what their fair market value is, and then you figure out what the difference is between what you paid for them and what the fair market value is, and there would be a tax levied on that gain. There is a gain exclusion that's adjusted for inflation each year. I think in 2018, I think it's like $700,000, somewhere around there. And so, as long as the gain's not more than that exclusion amount, you wouldn't have to pay the tax on it. One of the things that can help ease the burden with that portion of the tax is that you can actually sign an agreement with the IRS to defer the payment of the tax until you actually sell the asset. I think the part of the exit tax that really gets people is, like Leonard was mentioning earlier, the pensions, the IRAs, life insurance policies, annuities, things like that are treated as, distributed or sold on the day before expatriation. Those, wind up in a lot of phantom income that there's no exclusion for and that you can't defer the tax on. And those have the potential of really crippling people. So it's really important, like we've been stressing throughout the whole webinar, that if you're planning on expatriation, to sit down with a professional that's going to do an inventory of, it's going to review your tax returns, it's going to go through your assets and calculate, what the hypothetical exit tax is going to look like and how you can potentially reduce it.
Yeah, so I'll just add a few more bits on this deferral of the exit tax. It's not that easy to do. And in fact, when I was making telephone inquiries to the Treasury Department in Washington, D.C. a couple of years ago on this issue, I was met with the equivalent of verbal blank stares. Okay, they didn't even know what I was talking about. But once you make the selection, it's irrevocable, so there's no turning back. And you can make it on an asset-by-asset basis, so you can pick and choose which property will be covered by the election. But in order for you to get the approval of the IRS that you're allowed to defer the tax, you have to give adequate security, which no one knows what that means, to cover the tax, and you have to sign what's called the tax deferral agreement. Well, all this is fine and good, but you request that you can have deferral of the exit tax. You request that, I believe, on the Form 8854 itself. So the thing is, you've already expatriated, and you don't know if the IRS is going to grant you the approval for your tax deferral or not. So you could be stuck in a position where, you know, you're praying that you can defer, but they come back and say no. And there's truly no guidance I have ever found on this whole issue of what's adequate security, for example. Because if you don't have adequate security, they're not going to give it to you. They're not going to give you the ability to defer your exit tax.
Well,
And
I want to jump in real quick just on the adequate security thing. So, you know, in all fairness, I don't know anybody that's ever even attempted to defer the tax. So I can't say definitively what adequate security.
Yeah.
But I will say that, you know, when I think of it in terms of tax liens, you know, tax liens, in terms of getting them released, there's very similar language in providing adequate security to the government that they could release the tax lien. And when I compare it to that, typically, you know, what adequate security has been when you're talking about a tax lien is a bond, or in a lot of times the specific property that you would be deferring tax on if it can be secured properly. So if it was a piece of real estate, you know, that they're granted a specific security interest in that real estate, or something like that. So I imagine something like that would probably is probably what they're talking about. But you're absolutely right. There's a ton of uncertainty with it.
There's a ton of uncertainty, and by the way, you know, if you get to defer, you don't think the IRS is letting you defer payment of a tax without charging you heaps of interest. So by the time you have the continuous accrual of interest on the exit tax that is owed, and the requirement to maintain this adequate security, you might end up in an extremely difficult financial situation at the end of the day. Again, I don't know anyone who's ever done it. And I don't know any professionals that have actually worked with this and had it happen.
Leonard, have you had any experience with this? Or?
No, I have no experience with that. Nobody has tried to defer the payment of exit tax that I've worked with, and I've never even heard of a case of someone trying to do that. I wonder if adequate security would also mean that the assets would have to be domiciled or in trust in the United States.
That's a good point too.
So that the government would have
have
access to it. I mean, someone could have a mansion nowhere, but if it's in a foreign country where the courts don't have can't take possession of it. It's a very good question, but it's one of those, I've never seen it happen, and I don't anticipate seeing that, quite frankly.
Okay, let's move on. We have 3 questions left, and we can go for another 20 minutes or so, so we'll cover these 3 questions and wrap things up. So question 8, what are the estate and gift tax implications of expatriation? Leonard, do you want to get us started with that one?
You know, Virginia had mentioned the estate tax implications generally are the same as if someone is a non-resident alien, with the exception of Internal Revenue Code Section 2801, which basically says if you are a covered expatriate, okay, and you now bequest, you give a gift, or your heirs are U.S. citizens, the U.S. citizen is now going to have to pay tax at 40%.
Could also be a U.S. resident, couldn't it, Leonard?
Yes,
the recipient.
U.S. citizen or
U.S. citizen or resident. Any
and,
recipient that's tainted by U.S. is
correct. Not just a U.S. citizen, but a U.S. resident domiciled absolutely in the U.S. So that's one of the issues that I think myself, we have many people here that have moved to Israel later in life, and they have children and they have grandchildren that live in the United States, and they want to inherit the asset to them. What do you do? So there, in order to avoid 2801, and there aren't many planning options available other than gifting and maybe putting things in trust, which may have tax effects at the time of the transfer or not. But that really is something that penalizes U.S. citizens abroad. Basically, the U.S. just does not want people to leave the U.S. tax system. And when they do, and they see that money is somehow being repatriated into the U.S. tax system, even if it's through bequest, they're there to take their share of the money there. Maybe Jimmy would like to expand more on that. It's very important, though, for state tax purposes to realize a non-resident alien, if you have anything that's considered U.S. situs assets, that would also be subject to estate taxes, but for non-resident aliens.
The thing that I think is really important to add, and this is something that Virginia and I have talked about and worked on some in the past, is the burden of proving. So if you're a U.S. person and you receive a gift from a non-resident alien under these proposed regulations, you have the burden of proving that this gift did not come from a covered expatriate. And how are you supposed to know that? I mean, if your grandparent that moved back to wherever they were from 50 years ago, I mean, and you receive a gift for them, I mean, how are you supposed to know if A, they expatriated with covered expatriate, a non-covered expatriate? I mean, who knows? And so, one of the things that we've been advising clients to do is that if you've expatriated and you still have U.S. heirs, especially if you're a non-covered expatriate, because that's what's going to be important for the U.S. recipient to prove, is that they received the gift from a non-covered expatriate, because that would still be tax-free, is to put together a sort of expatriation package with the proper documentation and everything proving the non-covered expatriate status, and also making provisions for when this documentation and how this documentation should be transferred to the recipient. Like, is it done, via, is it kept with the will and transferred at the time of death, or how do you do that? Because this I foresee being a really big problem. Is that I think most people that expatriate just figure, okay, I'm kind of done with the U.S. and they never think about what happens to those U.S. persons that they leave assets to.
That's right. This is a problem that is going to be blowing up in the future. We're not seeing it right now, but again, it's coming. And it's sad that many people don't get the proper tax advice, because many professionals aren't even thinking ahead of the game here and saying, well, I've got to make sure that this guy understands he's got to have a certain package just ready for U.S. heirs or U.S. people that may be in his life, that they have to be aware that this might happen to them. The IRS comes and asks, where are you going to be able to prove that the gift or bequest was not from a covered expatriate? It's going to be difficult to do unless you're prepared for that.
Absolutely.
Okay.
Okay.
Let's move on to question 9 now. We have another 10, 15 minutes or so. What are the Social Security implications of expatriation? Virginia, do you want to start us off with that?
I think that was something that Jimmy's really dealt with pretty significantly. Okay. So I'd rather Jimmy take that one on. I know a little bit, but I think Jimmy really has worked with clients who've had this issue and collecting Social Security and knowing what's been taxed.
Yeah, so I mean, this is a question that I get a lot, especially from people that have spent a lot of their careers working in the United States, and they've accumulated enough quarters that they can get, or enough work periods that they're entitled to Social Security. Is what happens to my Social Security when I leave the U.S.? Am I still going to get it? Do I forfeit it? How is it going to be taxed? So on and so forth. And the short answer is you'll still get your Social Security. depending on where you move to, is going to depend on how much of it you get. So if you move, if you become a resident of a country where there's no tax treaty, then the U.S. is going to levy a 30% withholding tax. So basically, 30% of whatever your Social Security payment is every month is going to be withheld in tax.
85%, right? It's only, they tax 30% up to 85% of your payout. So it's not 100% of your Social Security payment.
No, that hasn't been my experience. I don't believe that. I don't believe that's correct. In my experience, they've kept 30% of everything that's been paid. Because if you go back and you read the withholding tax rules, it says it's 30% of the payment.
It's a U.S. source payment under FDAP. That's
correct.
And they take a statutory withholding rate of 30% or a low treaty rate. Now, theoretically, if one Social Security Social Security payments were not taxed because it does not exceed the thresholds of AGI, then one would probably be able to get back the withholding because withholding is just by filing a U.S. tax return, because withholding is simply that. The government wants to make sure that it gets their taxes. They withhold up front 30%, and if someone's Social Security payments were not taxable because of another interaction with the tax laws, meaning it just didn't meet that threshold, there would probably be a way to get that 30% back by filing a tax return, even a 1040-NR, just like any type of withholding, whether it's 1446 withholding for foreign persons who have real estate in the United States. So it's not necessarily lost forever, but there would be withholding up front.
But there's no ceiling on the amount of Social Security payment that can be actually taxed, because I know I've read there's this 85% threshold, but you guys have not seen that anywhere.
Well, I think Leonard gave the right answer, right? The IRS isn't calculating like what your income tax would be on it. That 85% comes into what you have to pay income tax on. The 30% is the withholding tax, and they're taking the 30% because it's FDAP income. And I think Leonard, hit the nail on the head that, if there's some other provision of the tax code that would, make the tax less than the 30% that was withheld, you could probably try filing, a 1040 or 1040-NR to get that.
Again, you may have
back, but I've not.
You may have treaty protection to reduce the rate as well.
Well, if there's treaty, if there's a tax treaty in place that lowers the withholding, then you can notify the Social Security Administration of that by filing the proper W-8, and then they'll withhold that lesser treaty amount right off the bat. Because ideally, if there's going to be withholding, you want to get the withholding right up front so that you're alleviated of having to file a tax return. Because otherwise, if you're entitled to, let's say, a 15% treaty rate and they're withholding 30, then you still have to file a tax return every year to get that money back.
Right.
And, it's not always so easy.
Correct.
It could probably be resolved with a lot of cumbersome paperwork, I imagine.
Okay. It's 2 o'clock, so I think I'm going to use the last question as a way of, I guess, closing remarks. I think this question is, it's important because many people think that, expatriation will solve their past tax non-compliance. So the question, I guess, to wrap up the discussion we've had here today is it true that expatriating will solve past tax non-compliance, or is this a myth? Leonard, how about we start with you, and then we'll work our way to the rest of you.
Well, that was actually answered by your very first question. To to what is a covered expatriate. The certification test actually says that you have to certify that for at least 5 years prior to the year of expatriation, you're fully compliant. So you cannot, it doesn't solve anything, it brings everything right to the forefront.
Okay. Any other concluding remarks?
Yeah, I would just add, and this just expands a little bit on what Leonard was saying, is that when you expatriate, it doesn't alleviate you of crimes or infractions that you committed while you were a citizen. You can't change the past, right? What happened happened, and so even if you were to expatriate and not check the box that you were tax compliant and just say, okay, I'll deal with being a covered expatriate, depending on your level of infractions against the U.S. tax law, isn't going to protect you from them trying to assess penalties from you. It's not going, to save you from, if you traveled to the U.S., potentially having a customs hold put on you and being pulled aside by customs, and depending on how non-tax compliant you were, it's not going to help you from criminal prosecution. All of those things are still on the table.
Mm-hmm. Virginia, anything in terms of concluding remarks?
No, I think that Jimmy has really succinctly put it. It's not going to protect you at all, and depending on the level of tax non-compliance involved, I mean, I could see the IRS digging their heels in and trying to deal with treaty partners, etc., to try and come after you if you're in the right country where they can do that.
Excellent. So I think we've covered all 10 questions. On behalf of TaxLinked, I want to thank the three of you for participating, Jimmy, Leonard, and Virginia. I think it was a very insightful discussion. I think our community will get a lot of, knowledge and tips on how to deal with U.S. expatriations from this discussion. Just to repeat some of the admin issues that I mentioned at the beginning, this webinar has been recorded, so we will have an audio recording and a transcript available to all of you within a few weeks, and we'll be blogging about it and sharing it on social media, sharing it with everyone. If you want to get in touch with the panelists and ask them follow-up questions, you can just use our forum, and they'd be happy to you and answer those for you. So with that said, on behalf of TaxLinked, thank you very much, and hope you have a great day.
Thank you.
Thank you so much.
Thank you, everyone.
Bye-bye.
Bye.
Thanks. Bye.
Bye.